Hi, I'm Tom Lydon in Hollywood, Florida at the Inside ETF conference. I'm here with Ed Lopez, head of ETF Products at VanEck, and Steve Blumenthal, who's the executive chairman and chief investment officer of CMG Capital Management. Gentlemen, great to see you.
Great, thanks.
So when we talk about innovation, you guys have a great story. First of all, I just want to say, we survey advisors all the time, and in a recent survey, 70% of advisors say they implement some type of tactical allocation strategy. You folks have packaged that in an ETF. Ed, tell us about it.
Yeah, you know, when we talk to advisors as well, and part of our product development process is trying to find solutions for them, whether it's tapping new areas of the market that haven't been tapped before or making improvements on the way that they do things. And one of the areas that we wanted to tackle was risk management and providing a way to get exposure to large cap equities, but with guardrails, if you will, ability to take you out into cash as the signals started to weaken.
Right, and so walk through this, Steve. You're an ETF strategist firm. You've been managing money for a long time. You have different portfolios utilizing a whole variety of ETFs, but you have tactical strategy. How does this strategy work within the ETF?
Well, we were trying to solve for our large cap exposure, and we wanted risk management tied to that indice. So if you think simple trend following, that's the beginning part of how we do this. So
say for example, you're on the S&P 500. You've put a 200-day average on it. And I'm just simplifying it because I know these aren't your words, but when you drop below moving averages, that means you take a little bit off the table? Is that
yes,
correct?
exactly. So the way that we operate a lot of people are familiar with the 200-day moving average, and a drop below would technically be a sell signal, a rise above would be a buy signal. A lot of investors use that, and so there's a lot of concentration at that spot. What we were after was looking at measuring the momentum across 24 different sub-industry sectors to say, what's the overall health? How is the industry doing? How are stocks doing?
Right. So it's not an all-in or all-out plan either, because you have certain levels that have to be hit in order for more money to come out or more money to come back in, correct?
That's right. Yeah. We wanted to give people the opportunity to participate in equity growth, but have that ability to go out into cash and be a little bit more conservative when the market breadth had started to weaken.
And understanding here, these are not how you feel about the market. These are all purely rules-based technical strategies.
Completely trend-based, looking at the short term, the intermediate term, and the long term across all these different sectors to say what's the overall weight of evidence in the market. Is it strong? Is it weak? And then as it weakens, we start to de-risk from exposure from the S&P 500 index.
We know emotions play a big toll on investors, especially during times of volatility, not just when the market's declining to make sure that you may be protected, but on the other hand, when the market's coming back. After the market's had a pretty big decline, investors have a tough time having the guts to go back in if they've actually exited the market. So as we look at this is one of the best strengths of this strategy, because boy, after a bear market, you want to make sure you've got a strategy that gets you back in, correct, Steve?
Yeah, exactly. So there's rules defined that are followed based on how you de-risk and how you re-risk to get back in.
Right, excellent. Okay, and the ticker symbol for the strategy?
LFEQ.
LFEQ. And if people want to find out more about it, they can go to
VanEck.com.
VanEck.com. Excellent. Steve, Ed, thanks so much. Enjoyed it.
Thank you, Tom.
Thank you.